Hello, welcome to this channel, Accounting Basics. Don't forget to subscribe, share, like and comment. In today's video, we're going to be looking at liabilities in accounting. What are liabilities? Liabilities are any debt your company has, whether it's a bank loan, unpaid bills, or any other sum of money that you owe someone else. So that you owe someone else, that's a liability. So in accounting, we'll look at various examples of liabilities. We have current liabilities, long-term liabilities, or you can call them non-current liabilities. We have contingent liabilities. Looking at current liabilities in general, current liabilities are debts that you have to pay back within the next 12 months. Those are the debts that are paid within 1 year. So if a debt is paid beyond 1 year, that becomes a non-current. Hope you're getting me well. Some common examples of current liabilities: we have accounts payable. Accounts payable, those are payments you owe your suppliers, those people who gave you goods on credit. So that is something to do with suppliers who give goods on credit. So we go on and look at principal and interest on a bank loan. Principal and interest on a bank loan sometimes can also be a non-current. If it goes beyond the next year, then that becomes a non-current liability. We have salaries and wages payable in the next year. Those are current liabilities. Notes payable that are due within 1 year. Those are current liabilities. We have income taxes payable. So income taxes are also current liabilities, because most of the times income tax is counted for within one financial year. We have payroll taxes. Then we go on to look at long-term liabilities, or you can call them non-current liabilities. These are any obligations payable, loans, and any other liabilities that are due more than 12 months from now. So they are payable, they are loans, and any other liabilities that are due more than 12 months from now. Some of the examples of non-current liabilities: we have principal and interest payable due more than a year from now. So that turns it into a non-current liability if it is payable within more than 1 year from now. We have bonds, debentures, and long-term loans. Those loans, you may find that you have to pay a loan within 10 years. That is a non-current liabilities. Deferred tax liabilities: we have lease payment. For example, you have to pay for a vehicle on a lease, meaning you will be paying for that vehicle for more than 1 year. In case you were to pay for it for 5 years, 10 years, that becomes a non-current liability. We have pension obligations. We have equipment and other capital payments that are due for more than a year. Those are non-current liabilities. For example, you were given an equipment to use in your business, but you have to pay for that equipment each and every year. So that is a non-current liability. You have a non-current liabilities. Probably there are two reasons why we separate current liabilities and non-current liabilities or long-term liabilities in the balance sheet. The first reason is that it makes it easier for anyone looking at the financial statements to figure out how liquid your business is. So they are trying to see how capable your business is in paying its debts. So this helps them in evaluating your business, and this gives investors a chance to know whether your business is making profits or it it is making losses. And another reason is that generally accepted accounting principles requires you to do so. It requires you to separate current liabilities from non-current liabilities. However, they have a similar take. You may find that you will find principal and interest payments in non-current liabilities, and you find it in current liabilities. The only difference is the time of payment. Is it taking 1 year or is it taking more than 1 year to pay that debt? We go on to look on contingent liabilities. These contingent liabilities, some business might record them as liabilities in their balance sheet. There are liabilities you might owe someone depending on the result of a lawsuit, or if you have to pay your customer back to satisfy the terms of a warranty. For example, you have to pay for a warranty. This is a liability caused due to cases, or like compensation for damages, yeah, that sort. So some companies, some businesses include them in their balance sheets, but it is not common. How to deal with liabilities? Liabilities have a credit balance, and if they are increasing, we credit. If they are reducing, we debit. In that case, let me hope you find this helpful. Thank you for keeping in touch. This is Accounting Basics. God bless you.